Recession fears have now plunged U.S. stocks into a bear market, with the S&P 500's decline now over 20% from its all-time high to start January 2022. The tech stock-driven Nasdaq is already deep in bear market territory, trading down over 31% off its highs. These are a few names which surged during pandemic lockdowns that have been crushed this year. Jeremy Grantham, famed investor with a track record of identifying market bubbles, says today's bubble is worse than 2000, and he calls for U.S. stocks to at least double their losses ahead.
I only specialize in what I call the really great bubbles. If you go back to 1929 to 2000, to Japan, and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. I mean, it is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. And people never get it. People never forecast it. And along with the recession comes a drop in profit margins. Going into the bubbles breaking, profit margins are always at a peak. Bubbles don't peak for no reason. They peak because economic conditions are nearly perfect. And that includes low inflation and high profit margins. And the first thing to go in a recession, of course, is the profit margin. And that is very likely to happen this time. We should be in a recession, mild or severe is the question. But we should be in some sort of recession fairly quickly, and profit margins from a real peak have a long way that they can decline. And if you want to get into the longer term, I think this kind of 2000 bubble that we have is dangerously likely to morph into the 1970s, where inflation is always a part of the background discussion, and where growth rate starts to dwindle away. So you have shades of stagflation as we had in the 70s, where commodities are intermittently scarce, price jags here and there, as we have seen recently, where the whole system is so strung out and so borrowed that it's lost its resilience. All you have to do is cough in COVID or a war in the Ukraine, and you see the problems ricocheting around the system that was not designed to absorb any kind of punch. Last minute inventory delivery, no reserves, putting all of your business with one country far away, no flexibility, no resilience. And now we begin to pay the price.
This is the 1990s Nasdaq bubble. And on a relative basis to today's bear market in tech stocks, here is where it was after having lost 31% from its peak value. If Jeremy Grantham is correct, he's now making his case in the heart of a U.S. stock market bull trap. The quote, return to normal bounce should not be too far away from now. Many have hopium, awaiting that the fiat Federal Reserve will save the stock market, but thus far, their delay in action has not been accommodating. Fundamental drivers of the consumer-driven U.S. economy are showing signs of real trouble. This week, Goldman Sachs published consumer credit-fueled purchases are at record high levels, illustrating that U.S. consumers are stretched and not making ends meet as consistent rising price inflationary pressures continue to eat into their household budgets. Meanwhile, gold appears poised to begin gaining in value versus the stock market bubble coming undone. Hello there, on behalf of SDBullion.com, this is James Anderson with a quick SD Bullion market update. Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible bullion giveaways like this one.
When you love silver as much as me, it's really easy to get carried away. Sometimes I just can't keep my hands off of a good deal. So when SD Bullion told me that they wanted to give away some silver for free, I was happy to lend my voice for the cause. Now how much silver are they giving away, you ask? Boom! Yes, 500 brand new Silver Eagle coins will be going to one of you. Just click the link below and enter for your chance to be the next big winner. Yep, okay, got it.
Click the link below to enter our new 500-ounce American Silver Eagle coin Type 2 giveaway contest. And good luck to all of you who take part. The gold and silver spot price market finally again had a positive week of trading action. The gold-silver ratio fell back to 84, signifying a bit more strength in silver than gold on a percentage gain basis. The spot silver price closes just over $21.75 an ounce, while the gold spot price closes just over $1,845 per ounce. Of note, the gold price close is slightly above gold's 200-day moving average. That gives gold bulls some positive news that recent selling pressure may have found its bottom. Officially reported price inflation continues hitting 40-year high levels. This past week, the United Kingdom matched their all-time low consumer confidence reading with an official inflation spike at plus 9% year-on-year. Germany's producer price inflation hit a new record high level this week, up 33.5% year-on-year. The jump in energy prices nearly doubling being the largest contributing factor in the data. Yet I'd like to take a moment here and remind you viewers out there, you likely know it already, that an even larger contributing factor to the ongoing price inflation globally was the coordinated central bank policy deal that was struck in August 2019, where not only Germany and the Eurozone, but also the UK, Japan, and the US central banks agreed to, quote, go direct and bring about current global secular price inflationary regimes that we're suffering under now. Remember, this was more than a half year before a global pandemic became any sort of an issue, which obviously shut down supply chains and had lockdowns globally. Increasing the global fiat currency supply by over 25% since then is basically what the August 2019 BlackRock Go Direct document stated point blank. It's a coordinated inflationary action permanently boosting the stock of currency outstanding. It will drive inflation higher, for in the long run, the growth of the fiat currency supply drives inflation. The Institute of International Finance reported this week that the total global debt levels reached a new record high of $305 trillion in fiat Federal Reserve note equivalent value. It's a number so large I'm not even going to bother trying to wrap it around any of our minds. The borrowing was driven mostly by Chinese and US government authorities. China added $2.5 trillion in debt, and the USA added $1.5 trillion. The total global debt to GDP ratio is now at 348%. A likely reason central banks have been, in the last few years, coordinating to usher in a new massive secular inflationary regime, likely to help debase and more easily nominally pay back record sums now owed. One way or another, from here to the next major financial crisis and the inevitable rewriting of the global financial rules to come, we suggest investors seeking to maintain wealth consider prudent bullion positions now. For ultimately, debts which cannot be paid won't be paid in real value terms, and the revaluing that results favors bullion in this tumultuous decade unfolding. That's all for this week's SD Bullion Market Update. As always, to you out there, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.